Hi, and welcome to Chapter 8. Today we'll be discussing risk and return. We're going to be looking at the fundamental meaning of risk return and risk preferences. We're going to be looking at the procedures for assessing and measuring risk. We're going to be looking at the return of a standard deviation for a portfolio and the concept of correlation. We're going to be looking at these concepts within the international assets of portfolio. We're going to be talking about the two types of risk, and we'll be discussing beta in measuring relevant risk in a security in a portfolio. We're going to be looking at the capital asset pricing model. So let's begin with the fundamentals of risk and return. Any smart investment is going to have a significant return and hopefully a minimal amount of risk. So the two key areas for discussion in making decisions on investments for corporations or individuals are risk and return. So each decision is going to present a certain risk and certain return characteristics. And the combination of these two can help increase a share price or decrease a share price. So what we're looking for is projects with a high return with a low amount of risk, and these will typically make a company less risky and increase their stock price. So analysts have used different methods to quantify risk depending on whether they're looking at a single asset or a portfolio, a company or a stock. They're all different scenarios. So let's define risk. So risk is the measurement of uncertainty surrounding a particular return. So risk is the chance that you may not get the return that you're looking for. Now return, of course, is the total gain that you experience on an investment over a specific period of time. And there is a formula for calculating return depending on the scenario. But essentially it's looking at your beginning price and your ending price. We'll get to the formula later. So if you think about ethics, for many years, Bernie Madoff, I'm sure you've heard of Bernie Madoff, has generated many high returns with seemingly very low risk for his investors. And then on December 11th, 2008, the SEC charged Madoff with securities fraud. And Madoff's hedge fund was actually a Ponzi scheme. So he was sentenced to 150 years in prison. And a lot of investors were so happy with his returns and so believing in what he portrayed as very little risk, they never really were able to discover that this was a Ponzi scheme. And a Ponzi scheme is basically when you use the new people joining the hedge fund to pay returns to the people who've been existing there. So if you come into the hedge fund, all your money is taken and posed as returns for somebody else. So as long as you keep getting in more and more people, it won't be discovered. But eventually, when the market turns downward, like it did in 2008, and people start withdrawing money from your fund, it's going to be discovered that there really is no more money because it was all handed out in returns. Okay. Here is the actual formula I was talking about, is calculating return. So if we want to look at the rate of return, we can express it in these variables, where RT is what is going to be the required return during a period. It could be thought of actual or expected or required. Cash flow is the amount of money received from the investment, usually in form of dividends. Price is the price of the asset. Price to the T is the price of the asset at the time of T. And price to T minus 1 is the price of the asset timing T minus 1. So basically what it's saying is cash flow plus the price of the asset minus the P minus 1 is the original price, so the beginning price, divided by P to the T minus 1, which is the original or beginning price. So it's really the gains from the investment divided by the initial investment. So here's an example of this in action. So Robin wishes to determine the return of two stocks she owned in 2012. At the beginning of the year, Apple stock traded for $411 per share, and Walmart had a value of $60 per share. During the year, Apple paid dividends of $5.30, and Walmart paid dividends of $1.59. At the end of the year, Apple stock was $5.32, and Walmart sold at $68.23. Calculate the annual rate of return for R. Okay, so what we're doing here is the dividend plus the ending price of the stock minus the beginning price of the stock divided by the beginning price of the stock. So we have a 30% return for Apple and only a 15% return for Walmart. And that is basically taking this formula think of a P to the T as the ending price, and P to the T minus 1 is the beginning price. So the hint here is that we're minus 1 is supposed to represent the time period from beginning to the end. Okay, so let's look at some historical returns from the average nominal return and the average real return. And so Treasury bills, and when we talk about these returns, we're looking at the returns and we're subtracting out inflation. So the nominal return is the total return, and the average real return is the return if we take away inflation, which is gauged at 3%. So Treasury bills had the lowest, then Treasury bonds, and then common stocks as a total return from 1900 to 2011. So risk return fundamentals, risk preference. So if you're risk averse, most people are risk averse. They want we're going to require a higher amount of return to compensate for an increased amount of risk. A neutral return is an attitude where risk, when choosing the investment, with the higher return regardless of risk. So risk neutral is saying that I don't care what the risks are, give me whatever gives me the most return. Risk seeking is someone who prefers investments with greater risk, even though they may have lower returns. So the smart money goes in the risk adverse pile. So risk neutral is really not fully thinking about the situation because you're not looking at risk. And risk seeking is just dangerous. You're seeking risk without proper return. So risk adverse is the only pool you want to be in as far as a smart investor. Okay. The risk of a single asset. So there's something called, as far as risk assessment, scenario analysis. So this is an approach where we're going to look at many possible outcomes and many possible chances of return. So it involves considering the worst case to the best case, and as many cases in between as you can rationally differentiate. And you want to put a risk and return associated for all the given scenarios. So that's one way to assess risk, is know all the possible outcomes. A range is a measure of assets risk, which can be found by subtracting the return associated with the worst outcome from the return associated with the best outcome, and that will be the range of return. So sometimes you want to look for investments that have a range of returns that's in the higher aspects of return than the lower aspects. Okay, so let's look at the risk of a single asset risk assessment. So let's look at this table 8.2, asset A and B. So we have initial investment of $10,000 each. If we look at the pessimistic, most likely, and optimistic scenarios, and the range of return is 4 to 16%, how would we assess this? So asset A appears to be less risky than B. The risk-averse decision maker would prefer asset A over B because asset A offers the most likely return at a lower range. So we have this lower range is what is optimal here than the 16%. So there's more risk here because the range is wider. Okay, so other aspects excuse me, of risk assessment is probability, the chance that a outcome will occur. The probability distribution is a model that relates probabilities to associated outcomes. A bar chart is the simplest form of probability distribution and shows a limited number of outcomes associated with probabilities. And a continuous probability distribution is a probability distribution showing all possible outcomes associated with probabilities in a given event. So this is just ways to express the risk assessment, and we'll be looking at those later. Now, let's look at the Norman Company, and the past estimates indicated that the probability of a pessimistic, most likely, and optimistic outcomes as follows: 25, 50, and 25% respectively. So note that the sum of these probabilities must equal 1. That is, they must be based on all alternatives considered. So here are the bar charts that we were talking about. So you can see for asset A, here are the percentages, probability of occurrences, and we have that 25, 50, 25, and here is asset B. So you see the dispersion is greater for asset B than asset A. So this tighter dispersion is what makes asset A less risky. If we look at on a continuum, we see that asset D has a much larger range. They both have the same average range or average return, which is important. But since asset C has a much tighter distribution, you're more likely to get a return between 11 and 19%. But with asset D, you're likely to get a return between 5 and 25%. So even though you could get a possibly higher return with asset D, it comes with a greater risk of getting a lower return as well. So a matter of fact, if we look at the black swan, is it ever possible to know for sure that a particular outcome can never happen? And the chance of it occurring is 0%. So in the 2007 bestseller, The Black Swan, not the movie, the book, based on finance, the impact of the highly improbable. So the author argued that a seemingly improbable or impossible event are more likely to occur than most people believe, especially in the area of finance. So the book title is a reference to the fact that for many years people believed that all swans were white until a black swan variety was discovered in Australia. So reportedly earning a large fortune during the 2007-2008 crisis, this author, by betting that the financial markets would plummet. So he was one of the few authors that actually predicted this financial disaster in 2007-2008, and he wrote a book about it. And the idea is that, sometimes events that we consider never likely to happen can happen. Okay, so let's look at the standard deviation. The standard deviation is a statistical indicator which can help measure an asset's risk, and specifically the dispersion of the risk around the expected values. So the expected value is actually an average return, which is expected to produce over time. So here's the formula for this equation, where R to the J is the returns for the outcome, and PR is the probability of occurrence of the J outcome, and N is the number of considerations. So here is, if we plotted this, we could look at the probability and the return, and we can take the probability times the return to get the weighted average. And that will give us our expected return. So we're just basically finding an average for asset A and asset B. Then we're going to apply the standard deviation formula, which you're all familiar from the many math and statistics courses you have taken over time. So this should be nothing new to you. So in general, the higher the deviation, the greater the risk of the asset. So here is, if we look at calculating asset A, we can take the average return, and we can take the actual return minus the average return, square the actual return minus the average return, list the probability of occurrence, multiply the probability by the squares, and then we get this function here. And if we find the sum of that function, the square root of the sum of this, which is 2%, so this is 2%, the square root would be 1.14, would be the standard deviation for asset A. If we look at asset B, following that same model, we get a standard deviation of 5.66. So since these have the same average returns, which is very important that the same returns are average returns, we could say that asset B is riskier because it has a higher standard deviation. Now, so historical returns and standard deviations over that 111-year period, we see that Treasury bills have a standard deviation of 4%, the Treasury bonds have a standard deviation of 10%, and stocks have a standard deviation of 20%. So you can't say that the higher the standard deviation, the worse in this case, because we have to use the coefficient of variation to factor in the average return. So since these returns are not equal, we have to use the coefficient of variation to put them on an equal footing. So we would see here that stocks are the most risky compared to Treasury bonds, but I think you would judge that these are definitely the riskier, but they're not that much riskier than Treasury bonds, and since their returns are possibly much higher, that's why a lot of people prefer investing in stocks. Okay, but not all stocks are created equal. So stocks are riskier than bonds, as we saw in the previous chart. But some stocks are riskier than other stocks. So in a recent study examined historical returns of large stocks and small stocks and found that the average annual return of large stocks was about 9.8%, while the return of small stocks was 11.9%. So the higher returns in the small stocks came at a cost, however, because the standard deviation in the small stocks was 32%, where the which was the deviation was larger than the average standard deviation of large stocks, which was 20%, which was about almost 12% larger. So smaller stocks had a higher standard deviation, and they were riskier than larger stocks, but they had a higher return. Here is what we call a bell-shaped curve. So if we look at one standard deviation, would be at a 68% chance of one standard deviation occurring. Two standard deviations would be a 95% chance that this will occur, and three standard deviations will be a 99% chance. So we calculated one deviation of return, but we can actually increase that to 2 or 3 to get better percent chances of probability of occurrence. So let's talk about standard deviations some more. So using the data in table 8.5 and assuming that the probability distributions of returns for stocks and bonds are normal, we can surmise that 68% of the possible outcomes would have a return ranging between -10 to 29% for stocks and -5 to 15% for bonds. 95% possible, this is two standard deviations now, 95% possible return range for a -31% to a positive 47%, 49.7% for stocks, and -15 and positive 25% for bonds. And if we so the greater the risk of the stock is clearly reflected in how much dispersion or range in returns for each confidence level. So two standard deviations will increase the range, but also the probability of the occurrence. Now, coefficient of variation, which I discussed before, is basically we take the standard deviation divided by the average return, and this makes the measurement comparable. So it's a measure of relative dispersion that's useful in comparing assets with different expected returns. So the higher the coefficient of variation, the more risky and more volatile an asset has. So if we look at the stock A and stock B, they have the same average return. So of course the coefficient of variation is going to have the same information as the standard deviation because the expected returns are identical. So if these expected returns were not identical, then they would have a different set. Then the coefficient of variation would be more accurate. But it's still accurate, but it's giving us the same information as the standard deviation because there's no difference in returns. Let's do an example from personal finance. So Marilyn is reviewing stocks for inclusion in her portfolio, and she's considering Danhus Industries and has gathered the following price and dividend data and assumes that each return is equally probable. So Marilyn will invest in stocks with a coefficient of variation of 0.75. So what she's doing here is, here are the stock prices, beginning, end, and the dividends paid for 13, 14, 15, and here are the returns. So she's factoring the actual returns divided by the beginning price, and we're getting the return percentages here for these stocks. So assuming that the returns are equally probable, the average return is 10.5%. And the standard deviation on this model, so if we go back for a second, so here are the returns of these 3 years, and she's saying that they're equally probable, so the average return is 10%. So using that 10% as an average, she can calculate a standard deviation of 5.6. And the coefficient of variation, would be that 5.6 divided by the 10.5. It's just not written here. So because we would take the standard deviation divided by the average return to get an idea. So Marilyn only invests in stocks with the coefficient below 7.5%. Okay. So that it's just sort of an example how you can look at your whole portfolio and get an idea of how the portfolio, each stock in the portfolio measures up to coefficient variation limitation. Okay, so a risk of a portfolio in real world scenarios, a risk of any single investment would be viewed independently of other assets. So new investments must be considered in light of their impact on risk and return in investors' portfolio. So a financial manager's goal is to create an efficient portfolio that manages risks so you get the maximum amount of return for any given level of risk. So here's a portfolio, standard deviation of a portfolio. So what we see here is that we take the weight, the proportion of the asset times the rate. So it'd be asset 1, weight times rate, asset 2, weight times rate, et cetera, and adding all these results together, and this would give us a standard deviation of the portfolio. Or actually, this would actually give us, not the standard deviation of the portfolio, I'm sorry, this would give us the weighted average of the portfolio. So James purchases 100 shares of Walmart at a price of $55 per share. His total investment in Walmart is $5,500. He also buys 100 shares of Cisco Systems at $25 per share, so his total investment in Cisco is $2,500. So the combined portfolio is $8,000. Of the total, 68% is Walmart and 31% is Cisco. So he's just taking the total of Walmart divided by the total of the portfolio to get this 68%, and the total of Cisco divided by the total of the portfolio to get 31%. So thus the weight would be 68% for Walmart, 31% for Cisco. Together, weight 1 and weight 2 are 100%. So if we're going to put this, so we wish to calculate the expected value and standard deviation for a portfolio, what we're calling X and Y, we could use this combined information below. So by combining the equal proportions of X and Y, their forecasted returns below. So here, forecasted returns for X and Y. So these are the years and the percentage returns for X and Y, and the portfolio return calculation. So we're considering here an equal portfolio of 50% and 50%. So this is going to be just really 50% of 8% is 4%, and 50% of 16% is 8%, and that gives us our 12%. So we see that, okay, so if we keep calculating 5 and 7 is 12, here would be 6 and 6 is 12, here would be 7 and 5 is 12, and here would be 8 and 4 is 12. So we have the same expected portfolio return for each year, but different actual forecasted returns. So if we're going to calculate, if we take all of the average returns to divide by 5, when we get a expected return of 12%. So if we take that 12%, we can get a standard deviation of 0, meaning that if the portfolio return and this is the portfolio return and the expected return are the same, there would be no deviation. There'd be no correlation. Okay, so and this is important because you could have assets that don't correlate or correlate perfectly or negatively. So positively correlated describe two assets that move in the same direction. Negatively correlated are two assets that move in opposite directions. So if you're perfectly positively correlated, we'd say that's a +1, a correlation coefficient of +1, and the two assets are moving in identical trajectories. And a perfectly negative correlation would be a correlation coefficient of -1, and two assets would move in directly opposite each other. And then on the scale, now the scale goes from +1 to -1, and we could have correlations anywhere from positive to -1. So here would be, these are perfectly positive correlated, that the two assets are moving in tandem, and these are perfectly negative, where the two assets are moving in opposite ways. So the risk of portfolio diversification, the more diversified your portfolio, the lower the risk. So to reduce the overall risk, you want to diversify your portfolio by combining or adding assets that have the lowest possible correlation. So, for example, you don't want to buy a portfolio that's all semiconductor companies because that's a high correlation. You may want to combine assets that have low correlation, so maybe companies from many different industries, to reduce the overall volatility of the returns. So uncorrelated is talking about two assets that have no interaction, therefore they have no correlation. They're just unpredictable, no correlation. So if we had asset F and asset G together, you see that they have big swings here, but together the actual return will be more shallow because they are the diversification and difference of these two assets are making the portfolio less risky. Okay, so let's look at forecasting returns and expected values and standard deviation for assets X, Y, and Z and portfolio X, Y, and ZY. So we have three assets here, X, Y, and Z, and they all have different returns from 2014 to 2018, and these are forecasted, and that they all have the same expected return and the same standard deviation. So if we make a portfolio of X and Y, we see that they have the same return, expected and return, an average return, and so the standard deviation is 0. So this portfolio of X and Y is going to return 12%, it's saying all the time. But a portfolio of X and Z is going to have a expected value of 12%, but since they have different returns each year, the standard deviation is higher because there's dispersion, because we go from 8 to 16% as far as portfolio return. So since there's dispersion of returns, we're not getting a guaranteed 12% like we are here. Of course, this portfolio is riskier because we can potentially get less than 12%. So since the standard deviation is 3, and it makes it comparable because the expected returns are the same. Okay. Risk in the portfolio, correlation, diversification, risk, and return. So consider two assets. Asset, we'll say a high and a low. So the expected return for the low asset is 6%, the high asset is 8%, and the standard deviation for the low asset is 3%, and the standard deviation for the high asset is 8%. So the performance of the portfolio consists of a low and high, depending on not only on the expected return and the standard deviation of each asset, but also how the two assets are correlated. So possible correlations. So we could have, so the range of returns as far as perfectly positive, uncorrelated, and negatively correlated for the high asset is from 6 to 8%. So these are the range of returns and in the correlation of the assets. Now, this is the rate of return from the high to the low. So if we go back, see it's 6 to 8% expected return. So our expected return is between 6 and 8%, and this return is going to be in any relationship of correlation. But the portfolio risk, if we go back and we look at the portfolio risk, the standard deviations are 3 to 8%. So we're going to have a range. We take one standard deviation, so we're going to add in the case of perfectly positive, we're going to have the range with 3 to 8%, which is what we have here. But if we have an uncorrelated, the range is slightly lower from, say, 2 to 8%. And if we have them negatively correlated, which means they can move in opposite directions, so one asset can be negative, moving negative when one asset's moving positive, we can have a range of a return from 0 to 8%. So that's why correlation and return in portfolio is important to consider. So let's think about international diversification. So in international diversification, we're looking to include assets from other countries with business cycles that are not completely correlated with the U.S. business cycle to reduce the overall risk of the portfolio and the responsiveness to the market movements. Now, over long periods, international diversification portfolios tend to perform better, meaning that they earn higher returns with less risk than purely domestic portfolios. And this is true in the United States, but even more particularly true in other countries. If you have a domestic, say, portfolio of German stocks versus an international portfolio, the international portfolio will be safer, have a better the better diversification will give a higher returns at lower risks. However, over short periods, such as a year or two, the international diversification portfolios may perform better or worse than domestic portfolios. So over time, it will favor the domestic, international, but in short spans of time, the domestic sometimes win out. So currency risk and political risks are unique to the international investing, where you don't have to face them as much as domestic investing, although some domestic companies do have international operations and earn monies from overseas, so they do still have some effect from those from political risk and currency risk. Because some company like McDonald's or Starbucks have stores throughout the world, and they're bringing back foreign currencies, so they have to convert that, so that's the currency risk. And there may be political unrest in these countries or certain law changes that would inhibit the profitability of these overseas operations, so that's why even domestic portfolios have some of this risk as well. Okay, so that's the end of part 1 of risk and return. I will see you soon for part 2.